Welcome to Her Money Revolution. I'm your host, Angela Brooks, your guide on this journey to becoming a wealthy woman. As a certified financial planner, owner, and advisor at Family Capital Management, I'm on a mission to simplify the conversation around investing and to help women generate more wealth by making their money work for them. Join me as we navigate powerful financial planning strategies to help you achieve your personal and professional goals. This podcast is your go-to destination for no fluff, easy to implement financial and investing advice. If you are ready to achieve audacious financial goals, dream beyond boundaries, and generate massive wealth for you and your family, this podcast is for you. Grab a notebook. Let's get started. Hello, and welcome back to Her Money Revolution, the podcast where we empower women to grow their wealth by making their money work for them. I'm your host, Angela Brooks, and today's episode is one that honestly, I think every married couple needs to hear, because there's a financial reality that catches many surviving spouses completely off guard. It's called the widow's penalty. And what's heartbreaking is this, that after losing a spouse, which is a very challenging emotional time, many widows actually end up paying more in taxes while living on less income. At the exact moment that someone is grieving, someone's feeling extremely overwhelmed, emotionally exhausted, trying to rebuild their life, the financial system becomes even harder. And unfortunately, most people don't learn about this until after it begins happening, right? So today, I want to talk through what the widow's penalty actually is, why it happens, how Social Security, taxes, Medicare, retirement accounts all play into it. And then most importantly, what families can do now to plan for ahead. So if you're ready, I'm ready. Let's just dive in. So what is the widow's penalty? It's a financial hit that surviving spouses face when their household income decreases, yet their tax burden and their Medicare premiums increase. It's caused by the sudden shift in your filing status from married filing jointly to single. And you do that the year following a partner's death or spouse's passing. So the widow's penalty, it literally is the financial squeeze, and I've seen it impact a handful of my clients as surviving spouses. And what is the most surprising to people is that even though your income decreases, your taxes increase. And it sucks, right? So why does this happen? It's because when you're married, couples file taxes together, they benefit from a wider tax bracket. They benefit from larger standard deductions. There's more favorable income thresholds. So for example, your tax rate, let's just say 24% bracket, it tops out around, if you're married filing jointly, $403,550 to be exact. For the same 24% bracket, if you're single, it tops out around $201,000, and to be exact, $201,775 for single filers. That's significant. That means that if you make, as now you're single and you make $205,000, you're jumping into the next tax bracket. You're no longer in that 24% like you were when you were married. Another example, larger standard deductions. So in 2026, the filing status numbers are, if you're married, filing jointly, your standard deduction is $32,200. If you're single, it's cut in half, $16,100. But after one spouse dies, the surviving spouse often shifts from that married filing jointly to single, and the tax bracket compress dramatically, as you just saw. So imagine this, that a couple may have built retirement income streams over decades, right? I work with clients every day. They retired at 65, 67, and they're 77. The spouse passes away, and their financial tax situation completely shifts because you have built a retirement income stream of Social Security benefit, pensions, IRA distributions, other investment income. And then when one spouse passes away, although some of that income will decrease, like your Social Security, possibly the pension, Surprisingly, sometimes that's not that dramatic, right? You will lose a little bit for sure, Social Security, but sometimes that larger amount does remain, or it's then supplemented to take larger IRA distributions, for example. But the surviving spouse may still have to pay or to take out those required minimum distributions, investment income, pension income, and then now just one Social Security check. That now that income gets taxed under a single taxpayer rules, no longer the married filing jointly. So now you're in a higher tax bracket. You are definitely paying higher Medicare premiums. You lose the deduction, the larger standard deduction. Not only that, you're feeling financially vulnerable at the worst possible time. You just lost your spouse. So since this podcast is Her Money Revolution, so why this impacts women so deeply? Well, statistically, women are more likely to outlive their spouses, which means that this conversation disproportionately impacts women. But listen, before I go deeper into why this matters so much for women, I want to pause and say something else. So I've been doing this podcast, Her Money Revolution, for almost 2 years now. And one of the most surprising and meaningful pieces of feedback that I continue to receive is how many men and how many husbands are listening to. So first of all, I want to say thank you. Truly, thank you. I see you. And I appreciate you being here. I really, really do. Honestly, I work with a lot of men. Actually, more of my clients are men. So I understand that these conversations impact you as well. This is not just a women's issue. I hear you. It's a family issue. It is a marriage issue. In fact, I recently brought on new clients just this last week. And so far, I have only met with the husband. We've had multiple meetings over the last couple of months. And even though I have encouraged him to bring his wife, and my email responses, I've encouraged the wife to attend, even if it's just by phone, like that's fine, or Teams meeting, she has not responded. She has zero interest. He tells me that she has zero interest in all of this stuff. She just wants me to handle it. Like, she won't even take a call from me. I've left voicemails. I don't fully understand why, and that's fine. I trust that I'll get her one day. But what he tells me is that she feels overwhelmed. And she feels really intimidated by all of this finance stuff, which I get it. She's assuming that her husband is handling it. And he is, this new client of mine, of what I know so far. He's trying to do the best that he can. I get it. She has young kids. She works. Life is busy. I understand that. I'm there too. But as a girl myself, and as a busy mom and business owner and all the things that I do, I also know something else to be very true. When something truly matters to us, we find a way to make time for it. When I really want something, I figure out how to get it done, right? And husband, if you're listening, you know I'm right. If your wife really wants something, she figures it out somehow, right? So husbands, listen. And I know I get really passionate about this. If you're listening, please help her want financial knowledge. Don't make finances feel intimidating or exclusive or your department. Maybe even tell her, hey, listen, I don't fully understand all this either, and I really would like your help. I don't want to make the money decisions alone. I trust your thoughts on this. Invite her into the conversation. Encourage her to ask questions. If not to you, it's like, hey, I don't know how to answer that. Let me send it to my advisor. Help her understand that this is not about becoming a financial expert overnight. I've been doing this for 12 years. And I still don't understand things. Like on a weekly basis, I'm like, okay, I'm not sure about that. Let me find out. It's a lot, right? But it's about building confidence over time. It's about building awareness and partnership over time, not just one meeting, but multiple over years. And listen, that partnership that I'm talking about, like just the definition of the word partnership, it's going to take so much burden off your shoulders, husband, right? You don't have to carry all of that financial pressure and the financial decision making and all of that responsibility alone, because your wife is your partner. Your wife is your helpmate. So help her get involved with these decisions. It's going to benefit your marriage like crazy. I promise you. I can't guarantee much, but I can promise you that. Because when your spouses are engaged, when both spouses are engaged, even at different levels, right? Like She doesn't have to be the expert. She doesn't even have to be the final decision maker, but having her be a part of that decision-making process is going to be motivational for her or help her have more peace around it. Or maybe not have peace. Maybe now she understands why you're coming home so stressed. Now she gets it. Then you've got a partner with you, right? So even if it's at those different levels, there's going to be more peace and there's going to be more communication and better decision making in the long run and less fear around money. Because when you look at it more often and you talk about it more often, that fear goes away. So financial partnership creates unity. It allows you both to navigate life changes and to navigate setbacks and opportunities, right? And long-term goals become together, right? Instead of just one person silently carrying that entire weight of the financial world for your family and your kids. And that impacts everything, right? When you have a spouse that's on board with you, it helps. So men, let me ask a favor of you. The next time you hear something on this podcast that resonates with you or feels important to you, don't just send the episode to your wife and say, hey, you should listen to this. Or don't just say, hey, I was listening to the podcast and I learned this. Actually take time with her. Sit down with her and listen to it with her. Pause the podcast, go grab her and listen to it together. And then open up for conversation. Ask her if she understands that. Ask her if there's any questions, right? Ask her how can you help her feel more informed and more involved financially. And I really, really believe that this is so important in marriage. And again, the goal is not that she suddenly understands everything overnight. Most people don't. The goal is simply helping her understand more than she did yesterday and helping her understand why these conversations matter. Last thing I'll say on this, because when one spouse carries all of the financial knowledge, it will unintentionally create fear. It just does. And it will create dependency, confusion, overwhelm, maybe later on in life, but it will. And especially during difficult transitions like the one that I'm talking about today, when you lose a spouse, okay? So why this matters so deeply, specifically for women, okay? Statistically, women are more likely to outlive their spouse, which means that women are often the ones eventually making financial decisions, and they're going to be doing that alone, right? Navigating taxes alone, handling healthcare decisions alone, managing retirement income alone. So clearly this topic matters far beyond just taxes, right? Because if your wife or you as a female, if you're listening right now, if you are not involved, if you're not the primary financial decision maker today, or even part of that process, if you're not understanding the retirement strategy, maybe you suddenly inherit large financial decisions and now you're grieving the loss of your spouse, you're going to experience this fear and uncertainty and overwhelm and possibly make really poor financial decisions. So this is why it matters. This is why financial planning is not just about investments and growing your money. I like that too, trust me. But when I talk about living life rich, it's not about just your money. It's about preparation. It's about clarity and communication and stewardship. I believe God blesses us, and it is our responsibility to steward our resources well. And the more you're involved, the more you communicate, the more you're prepared, the better steward you will be. I believe that is the greatest gift that couples can give each other, is this financial transparency ahead of time before crisis ever happens. And I hope that's not your story. But if it is, I hope you're getting help. So let's go back to what specifically changes. Let's get into a little bit of the details, right? So when a spouse passes, Social Security is one of the biggest and one of the bigger shocks as well. For whatever reason, a lot of couples don't realize that when one spouse dies, the surviving spouse does not continue receiving both Social Security benefits, right? Typically, you only keep the larger of the two benefits. So your household income can drop significantly overnight. Every case is different. As a spouse, your husband might receive $40,000 in Social Security benefit, and the wife might receive $38,000. Okay, so that would be significant, right? That's almost half. You no longer would receive your $38,000. You would receive the $40,000. That's significant. And maybe it's not so much, right? Maybe the husband in this scenario or example, maybe the husband makes $40,000 and the wife only makes $10,000. Okay, well, $10,000 isn't that hard to, I mean, it's big, it's a lot of money. It is a big deal, but it's easier to supplement that. It's easier to kind of change lifestyle when you're used to that 10 extra. Now you're not. Okay. Taxes. The tax system changes. Like I've addressed earlier, the surviving spouse will lose nearly half of the standard deduction. It's cut in half. You move into a compressed tax bracket, and then you're going to be paying higher marginal tax rates sooner. So not only are you dealing with the emotional frustration or the emotional loss of your spouse, now you have this frustration that many widows feel, you're not alone in this, that you're now paying more taxes when you have less income. Medicare IRMAA is another big one. IRMAA stands for Income Related Monthly Adjustment Amount. It's another hidden issue. What this is basically an extra surcharge that is added to your Medicare premiums if your income is above a certain level, okay? So higher income triggers IRMAA surcharges, which increases your Medicare Part B and Part D premiums. So I think next week or my next episode, I'll talk more about IRMAA. I'll dive into that a little bit more because I've had a lot of questions recently. But basically, the government looks at your income from 2 years earlier to determine whether you owe IRMAA or not. So for example, 2026 Medicare premiums are based on your 2024 tax return. So for 2026, IRMAA starts when income exceeds, for a single filer, approximately $109,000. For a married filing jointly, that's $218,000. It's a big difference. So because the thresholds for single filers are much lower, surviving spouses suddenly get pushed into higher Medicare premium bracket. So now you're paying more. Another direct impact is the required minimum distributions, right? This is when you're required to take money out of your retirement accounts, traditional IRA, traditional 401k. And sometimes these RMDs become more problematic after a spouse dies because that same IRA balance is now being taxed on a single tax return versus married filing jointly. And there's a lot of proactive tax planning that I do with my clients to avoid some of this, regardless of losing a spouse, but just looking at different incomes later in life. So let's jump into that. What can couples do today? What can you do now? What questions should you be asking your advisor to make sure that you're prepared for this and that you don't have to worry about that widow penalty? This is where the conversation is hopeful. If you're like, okay, Angela, this has been doom and gloom and I know, sorry. Now let's put some hope, because there are some strategies that families consider before this widowhood occurs that are not hard. So, and this again is part of that comprehensive financial planning that I personally do with my clients to help mitigate the possibility of the widow penalty. So a few of these strategies, a wealth conversion. So what this is strategically converting traditional IRA or traditional 401k funds to Roth IRAs while both spouses are alive to reduce the future required minimum distribution on a lower taxable income. This is one of the biggest planning opportunities that you can utilize, really. So I'd encourage you to work with a CFP to find that sweet spot in your plan, even if it's not for, the widow penalty, but finding that sweet spot where between the years of maybe you retire and then before you start taking Social Security, where you don't have a lot of taxable income, you can go ahead and do this Roth conversion, because when you convert over, when you convert those traditional IRA funds to a Roth, you pay the taxes. So let's do some tax planning and find out if it makes sense to do that. Not only do you help with taxes, the Roth IRAs grow tax-free. Another strategy to help mitigate the possibility of the widow penalty is to maybe delay your Social Security benefit. Having the higher earning spouse delay claiming Social Security benefits until the age 70 could be a good strategy to lock in the highest possible survivor's benefit, right? I work with my clients all the time to evaluate multiple income strategies to determine what makes the most sense based on their personal goals and their tax situation and their investment portfolio and the long-term retirement plan. So it doesn't always make sense to delay till 70, but this could be a good strategy to help mitigate that penalty. We give you an example. So like when I work with my clients, I may compare taking your Social Security benefit earlier versus delaying that benefit and temporarily supplementing income from your investment accounts, right? So if you take your Social Security, you don't need to pull so much from your investment accounts. But if you delay it, you still need to supplement your income. So now you're pulling from your investment accounts. In some cases, that works. And in some cases, delaying Social Security can create significantly larger guaranteed lifetime and survivor benefits for the clients. While in other situations, taking that benefit earlier may be more advantageous. So needless to say, the key is understanding the trade-offs, right? Between that guaranteed Social Security income, portfolio longevity, taxes, IRMAA implications, surviving or survivor planning, and obviously your overall cash flow needs. So these are all the things that I would help as an advisor before you have to make that decision. Another strategy could be qualifying widow or widower status, right? So that's, you actually file with the IRS. A surviving spouse with a dependent child can file as a qualifying survivor spouse or surviving spouse. And you can do this for up to 2 years after the death of your partner, okay? So this can allow you to keep the more favorable married filing jointly status, and obviously then the wider tax brackets for a limited time for those 2 more years. It truly provides meaningful tax saving during an already emotional and financially difficult transition period of losing a spouse, especially if you have a dependent child. Tax diversification is another important concept. And what I mean by this is not having all of your retirement assets trapped in a taxable IRA or traditional 401k. You want to have a mix. You want to diversify. And I think about diversification, that's not only with the investments that you're investing in, but the vehicle that you're investing them in. So you want to have a mix of Roth assets. You want to have brokerage or non-retirement accounts. You want to have some cash savings. And yes, the tax-deferred retirement accounts. But having a diversified bucket to pull funds from will create tremendous flexibility for you later in retirement. And why that matters to have diversified vehicles or tax strategies is because your different account types are taxed differently. If all of your retirement assets are concentrated in a tax-deferred account, like a traditional IRA or a traditional 401k, 100% of your future withdrawals are taxable. And this, most of the time, creates a larger taxable income. You'll have higher Medicare IRMAA surcharges. Increased taxation on Social Security benefits is a possibility. And potentially, you could push surviving spouses into higher tax brackets after the loss of a spouse. So when we look at, especially if you're younger, if you're like, okay, a lot of this information doesn't really apply to me today because I'm young. Maybe my parents could listen to this or my grandparents, but this is where it does. If you're 20 or 30, this is where it doesn't apply to you because this tax diversification allows retirees, when you're retired, if you have done this earlier on, started these Roth buckets and brokerage accounts, then that diversification allows you in retirement to strategically decide where income comes from each year. It gives that power back to you. So for example, in 1 year, it may make sense to pull cash from your brokerage account to keep your taxable income lower. Well, the next year, it might make more sense to intentionally take more out of your traditional IRA or maybe complete a Roth conversion because you're in a more favorable tax bracket. So I work with clients to build retirement income strategies that create this flexibility and that control over your future taxes. So it's not just investment returns, right? When you think about working with an advisor, it's not just talking about investments. So many different things, right? Properly diversified tax strategy will help you reduce your lifetime taxes. It will improve your retirement cash flow. It will help you manage IRMAA, reduce the future impact of required minimum distributions. It will help you create more efficient legacy planning if that's something that you are passionate about. But it's going to provide you flexibility and it's going to give that control back to you, especially in market downturns or major life transitions. So the goal is not necessarily to avoid taxes altogether, although I wish I could find a strategy for you there. There are different things you can do for sure to minimize them, but that's not the goal, right? We pay our taxes. There's 2 certainties in life. You got to pay your taxes and you will die. But the goal here is to create options. The goal here is to give you flexibility so that you can make smarter decisions throughout retirement. Another important strategy here is beneficiary and estate planning. It's important to have beneficiary designations, all of your accounts. possibly having a trust, power of attorney, the proper estate planning documents matter. And again, it's not just wealth transfer, but for reducing the confusion later in life, reducing conflict, possibly delays or chaos during what is already a very emotional time if someone passes. So many people assume that their will controls everything, and that is not true. The reality is that beneficiary designations on retirement accounts or on life insurance policies and investment accounts will override the will entirely. So this is why keeping these documents coordinated and updated is really critical, right? If you have a will and in your will it says, I want all of my money to go to my child, Johnny, but in reality, your traditional IRA has a beneficiary designation on it, and it says 100% primary beneficiary goes to my Uncle Rob. Well, shoot, Uncle Rob's going to get it, not my son, Johnny. Doesn't matter what your will says. Okay, so we want to have those, make sure if you have a will, it is coordinated with the beneficiary designations. Okay, so I often tell my clients that estate planning isn't just about preparing for death. It is a hard conversation because it's all those scenarios, but it's about creating that clarity and protection for the people that you love, right? While those people are going to be navigating one of the hardest seasons of their lives. So it's not controlling it from the grave, unless you get too controlling and detailed. That's maybe what it actually is doing. But more than that, it's helping your loved one navigate these conversations. So when you have a well-structured plan, it will leave that surviving spouse or family member that no unnecessary stress. It'll help them avoid that. It'll help them avoid financial mistakes or family conflicts, siblings arguing, possibly, costly delays. If there's not beneficiary designations unfiled, then you got to go to court and find a probate judge. And I know that could be costly and emotional, right? The last point that is helpful to mitigate the widow penalty is financial transparency. It's one of the simplest things that you can do. And one of the most important steps is to talk openly about your money with your spouse or your partner. Too many spouses do not fully know where the accounts are held, how many income flows into the household, what bills and debts are there, how the investments are managed, what insurance policies are in place, what would happen financially if something changed tomorrow. Often just one spouse naturally handles most of the financial responsibilities, and we've already addressed this, but that is okay to a certain level. But then at some point, if the other spouse is completely ignorant to all of these things, it will create stress, significant stress and confusion. And you don't want that during an emergency or an illness or disability or death, right? We want financial transparency ahead of time. And it's not about creating fear. It's about creating that confidence in that partnership to be prepared. Even basic conversations will help tremendously. So if you're listening to this and you don't know what your household brings in, you don't know how to log into an account, like all of your accounts, your husband's 401k, even your health insurance, or the benefits. You don't know if you even have tax or estate documents or what you've paid in taxes. Do you have insurance coverage? How to access your retirement accounts. I actually had a client the other day. I met with a client, his wife passed away, and he didn't know how to log in. He couldn't get into. He's like, yeah, I knew all this stuff. I know our passwords and stuff, but I can't get into her phone. I don't have her phone password. I don't know how to verify. They send texts to verify the login, and he can't get into her actual cell phone. So he's now working with, I think it's Verizon, to figure out how to unlock the phone. Again, he can get it taken care of. It's not the end of the world. And yet it's a really hard season for him. He just lost his wife. So the last thing he must do is go walk into Verizon and ask to unlock the phone, right? It's overwhelming. One of the greatest gifts that you can give your spouse is this transparency, is this clarity. Because when your financial information is organized and it's openly discussed, you as a spouse or your families, you're better equipped. And when you're better equipped, you make wiser decisions and you avoid unnecessary panic or overwhelm. You understand how to navigate difficult life transitions a little bit easier. There's a little bit more peace and stability. So in closing, I want to say one more important thing here, that planning for widowhood is not negative. It doesn't have to be fear-based and doomsday. Go into this as understanding that it's love, it's stewardship. It's saying that I care enough about the people that I love to prepare them well. And if you're someone listening today who has lost a spouse, first, my heart goes out to you. And second, please know that if you felt financially overwhelmed, after a loss, you're not alone at all. Many, many widows experience this exact financial pressure and overwhelm. So let me today remind you that wealth planning is not just about growing assets. Wealth planning is about protecting people, protecting your peace, your dignity, protecting your options, protecting the surviving spouse sitting at that kitchen table one day trying to figure out what happens next. That's what wealth planning is. That's the real financial planning. That's what I love to do. So that's all I have for today's episode of Her Money Revolution. Until next time, keep building, keep believing, keep pushing, and keep blessing others. I'll see you next time on Her Money Revolution. Thank you for joining me today, and I hope you are feeling more empowered in your financial journey. Remember, follow and subscribe to Her Money Revolution on your favorite podcast platform, and share your feedback by leaving a review. I'd love to hear your biggest takeaway from today's episode. Until next time, stay inspired.